Hi. Confession, say the Jesuits, is good for the soul. It's of course also good for the confessor, who learns all your secrets. But why is it good for the confessee? Because allegedly, he or she can learn from his mistakes, and so next time, hopefully not repeat them, which of course is very hard, mainly because the mistakes of sinning are pleasant and going straight is boring. Or, as a famous Christian sinner named St. Augustine once said, God, please make me virtuous, but not just yet. Now, we are on the topic of investing. What's the sinning there? It's of course losing money. So what investment loss making mistakes am I hinting at here? Today I have to mention two, and both have to do with my constant temptation of turnarounds, and tech turnarounds at that. That's my investing sin, as you probably know if you've been watching this clip for a long time. For me, it's a great temptation looking for tech turnarounds, especially since I have a method that very few use, so I can imagine I have a secret source that should let me take the money of the ignorant in the market. Does it? Occasionally it does, but not always. And what is this secret investment source in tech? As you probably know by now, my calculation of tech companies' hidden value is different than most investors. While non-tech companies have hard assets like machinery and real estate and building that can be resold and so provide a base for valuation, in tech companies the value is usually in IP, intellectual property, or patents which are the results of R&D spendings. So here is my secret tech valuation source. Because if a tech company is spent on R&D, especially the deeper the development, and it's working well, and it creates an innovative product or service, a competitor has to spend at least as much to compete with the resulting successful product, which gives the spender an edge for a while. Therefore, what I do is I sum up the last 3 years of R&D spending as an estimate of the IP value, and then I compare this number to the enterprise value of the company, the market capitalization plus debt less cash. In other words, I want to buy the company's usable R&D of the last 3 years at a discount via the enterprise value. But you may ask, why 3 years, not 4 or 5 years? The answer is because most R&D lasts about 3 years on average before it begins to degrade. Now, big companies' R&D may last longer, small companies shorter. So as a first cut, I take the average of the R&D in 3 years. Although for big companies, I may allow a higher ratio of EV to R&D. And does it work? In most cases, it works beautifully. For example, this method helped me catch Meta at $95 a share before the stock went up 6 to 7 times in 2 years. Or it helped me catch Merck or Moderna at the very bottom before they flew higher, and a few others with the tech components like Albemarle or others. However, more recently, the method also gave me two heartburns. The first was LivePerson, LPSN symbol. The second, Illumin, ILLM-T in Toronto. Both of these stocks fell after I fingered them, and so I confess these two mistakes here to see what I can learn from them. Let me go over these two one by one and see, first, why these two stocks blew a gasket, second, what I learned from this mistake, but three, and most important, how I can modify my method in the future so as to still catch the successful turnarounds, tech turnaround that is, while giving the problem ones a miss. Let's go to LivePerson first. The company uses AI to automate customer calls for airlines and other customer interaction-based enterprises. It also had 4 cycles of R&D before, when the rising R&D took a while to make an impact and drove the stock up more than 10 times from the bottom to top. Pretty big enticement. Both these factors, high R&D and the stock cheapness in relation to the R&D, And of course, regular cyclicality made me sleuth it out. This was when the stock was 2 and 3 times higher than here. It was trading even then at half enterprise value, which normally was a sign of cheapness. Indeed, everything in LivePerson looks good, except for one small thing, the balance sheet. The company had a bit too much debt. But so what, I said. The R&D was so abundant and the price so cheap. And also the company got an excellent new CEO who turned around a simpler company in the past. So I said, I am getting so much R&D value, the balance sheet will be easily fixed when others see the value too. Famous last words. Why? Because the R&D is a slowly depreciating asset, while debt is forever. What happened was, suddenly, the abundant AI technology began to threaten all software-based companies, and so any stock to do with software was hit, and so was LivePerson. Its R&D, which I relied on, suddenly was seen as worth half or even a third of what I usually value it at in previous price bottoms. The clients of the company began to hesitate too, so sales languished while the debt remained, and so the stock tanked and had to get emergency funding from a corporate investor under duress, and this corporate investor, SoundHound, S-O-U-N symbol, charged an arm and 2 legs for the rescue. This diluted the hell out of LivePerson stock, and so its stock is now down 70% from when I figured it. And the company who bought it, SOUN, will likely get a big part of the benefit. And what's even worse, it's allowed to invest more if, as and when things improve. So it has a chance to get more of future benefit, which of course means that SoundHound, SOUN symbol itself, is now a sleuthing target because its prospects are now so much better. But that's a topic for future video clip. Back to LivePerson. Yes, it was only one of 2 failures among 10 other good turnarounds, 8 of which worked out really well, but still it hurts. Now, what did I learn from it? I learned 2 important lessons. First lesson, when I buy into a tech company with lots of R&D, the ratio of some 3 years R&D I should be willing to pay for via enterprise value should be lower than what I used to pay in the past, perhaps much lower. The second lesson, the balance sheet of an R&D heavy companies matter a lot more than I thought, especially those companies on the front end of innovative technology. But even a third, a bonus lesson, what I, an above average tech investor, identify as even value may not be what others see. So if the balance sheet has to be revamped, the rescue may be more costly than anticipated and take longer. The bottom line, do I sell it now? Well, no. I may be wrong on the timing, but I'm sticking with the stock because it may still have a big upside like it had before. And besides, I already paid for my mistake, so I at least stay for the benefit, if any. I mean, I sinned and would like to be virtuous in the future, but not just yet. Why not? Because sometimes it does take longer for the turnaround to turn, and then it pays in space for the wait, sometimes. Okay, second legging turnaround, Illumin, ILLM-T. This one is a Canadian company with software to help digital marketers with a proven business cycle. In previous 2 cycles, the stock went up first 10 times, then 20 times from bottom to top, and then it tanked. The last time it tanked, I took an interest, but like LivePerson, my interest was too early. The stock fell 50% from when I first mentioned it. Less than LivePerson, true, but still, even 50% fall hurts. Why did I pick it? First, Illumin 2 was selling at a fraction of its R&D spending, but it had no debt, and also even had plenty of cash. And it too, like LivePerson, got a good new CEO when the founder stepped aside to enjoy life. And most important, insiders for Illumin were buying, and the company itself was buying back its shares, both a very good sign. So what happened? The same AI tsunami that happened to LivePerson. Suddenly, customers of Illumin could duplicate some of the product functions via cheap AI, so the stock tanked. But the difference between this one and LivePerson was Illumin had a sparkling balance sheet, lots of cash and no debt. So sparkling that the company kept buying back its own shares all through the decline because free cash flow was still abundant and still is, and is positive. In fact, even when the new CEO left and the founder came back as CEO, the company continued to buy back shares and the executive bought more shares too. The conclusion, same as above. The tech companies are prone to destructive new tech. I should always pay less in enterprise value for existing R&D and mind the balance sheet extra carefully. In fact, Illumin healthy balance sheet helped Illumin stock sink only 50%, with a live person saying 70%. So what do I do with the stock now? Here too, I am keeping it because the margin of safety of cash per share is solid, as is the product, and the old CEO is back. And of course, insiders are still buying at a lower price. Now, what have I changed in my R&D method due to this duo of temporary duds? All in all, I am going to try and do fewer turnarounds in the future and avoiding the bad ones. But like all recidivists, like St. Augustine, I may still like to sin every now and then with tech turnarounds because in investing, as in life, sins may often bring delayed joys that those who always walk the straight and narrow often miss. That's all for now. Please let me know what you think of the above, and if you like the above, subscribe to the channel and tell all your friends and subscribers so they subscribe too. Then buy my books, The Sleuth Investor and The Advanced Sleuth Investor, and give them a review on Amazon, which I hope will be a good one. I'll see you next time. In the meantime, thank you very much for watching.